Thank you all for coming and welcome. It's great to see so many friends and former students here. My name is Kevin Gray. Francis Lively asked me a few days ago to fill in for him as the MC today, and I'm happy to do that because it's such a great program, which I had really nothing to do with, but it's exciting to see it, and I'm as excited to be part of it. First, I would be remiss if I didn't thank the International Center for Finance and Will Getzman and Leanne Clark and Herod Rowenhorst. They've given us amazing logistical support. And I need to also thank Francis Lively, who's not here today, but really put this whole thing together with the help of Nima Vupalari and a number of our committee members, some of whom are speaking today. So please, let's give them a round of applause. And I think what's so great about this conference is it's a moment to reflect on where we are in the business. And when I look back on the industry and all of its ups and downs, many of you are too young to remember the savings and loan crisis in 1988. I know I'm going way back, but we used to say stay alive until 95. You know, no one did a deal in 1990, and I'm proud. You know, I had to keep my staff happy in New York, and I'd literally take them to the movies in the middle of the day and to lunch. And we'd come back at 4 o'clock and there'd still be no phone messages for us. And we did stay alive, and we didn't even need to stay alive until 1995. Things turned around really rather quickly and unexpectedly. And then we had the Russian debt crisis. Any deal that didn't close by September of 1998 didn't happen. And then, of course, we had the global financial crisis. So I thought every year ending in 8 is going to be a bad year. But I was wrong because the pandemic didn't happen until 2020. What's amazing about each one of these crises, though, is how our industry responded to what we, the people, what consumers want, what the end user wants. And so today is really about the future, about all the innovation that our speakers are involved in, the new technologies, and real estate, which has been traditionally very resistant to change and very slow moving, has been accelerated. So it really gives me a lot of pleasure to introduce our very first speaker, Paula Campbell Roberts. Paula is a Yale graduate, of course. She did go to that other business school for her MBA. But Paula is at the intersection of private wealth and real estate, which has become so important in the last few years. We've seen pension plans and endowments outbid by private families. Their strategies are maybe more willing to take risk, but they're also responding again to the post-pandemic world in a different way, some major differences, some minor, but very exciting what they're doing. So please join me in welcoming Paula to the stage. Thank you.
Thank you so much. Thanks. Good morning, everyone. It's really great to be back on campus. As the presenter mentioned, I attended another school for business school, but without a doubt, when I think about the foundation of my learning and where I sparked that intellectual curiosity, it was here. And to make that very clear, when I was up at that other school and there was a Harvard-Yale game, it was very clear what line I stood on. I didn't talk to my classmates during those few days, so I still bleed blue. It's really a pleasure to be here today with that backdrop. What I thought I would do was, one, give you the answer first. So my first slide is a little bit of a summary to the question that was posed to me, which is, what's the opportunity in real estate given all of the turmoil and complexity, including elections in the world? How should we think about the opportunity? So I'll start with sort of the answer. But General Petraeus is on staff at KKR, and I count him as a mentor and sponsor at the firm. And one of the things he always implores me to do is to get the big ideas right. So after I give you the quick answer to the question, I then want to pose a set of big ideas that I think are really important to understanding not only the opportunity in real estate, but this new investing environment we're in which real estate is well positioned. So hopefully that gives you some good ideas to think about. I will try to keep my remarks to 30 minutes and leave some time for questions at the end. So thank you again for having me. Is the clicker working? We're reloading. There we go. All right. So a lot of words on this page. I can actually barely read them here. But the good news is despite the tightening cycle, the central bank tightening cycle that we've experienced all around the world, in general, economies have held up quite well. And even in particular in the US, which has been the most aggressive vis-a-vis the Fed, we are actually quite constructive on growth. We believe that we should experience a soft landing, so growth should slow maybe to around 1%. But in general, we're quite constructive. I sit on the New York Fed Economic Advisory Panel that's chaired by Williams, and literally in the meeting 2 weeks ago, we were high-fiving around the table because the Fed has seemingly accomplished what many thought was impossible. Most people thought we'd be in a recession right now, and instead the US is still putting up pretty constructive growth. So I think that continues. But importantly, and the answer first for this audience, is because the Fed did cut rates by 50 basis points, and we think there are 8 more times over the next year that the Fed will continue to cut, maybe more, closer to 25 versus 50, that is going to be a tailwind for many asset classes, and certainly real estate is positioned to benefit. One of the big ideas that I'll touch on and why real estate should do well is what has shifted in the economic environment is the fact that we should experience a lot more, not just inflation, which has now come off the boil, but inflation volatility. And I'll tell you why in a couple of moments, but because we should expect a lot more inflation volatility, that has implications for our portfolios because public equities and public fixed income are behaving more and more similarly. And it's much more important today, especially for the individual investor, to find diversification elsewhere. And a major source of diversification is in real estate, right? And so I'll talk a little bit about that. And so to draw this to a close then, where should we be positioned, or where do I talk to individuals and institutions about positioning in this new environment? Well, right now in particular, leaning into equity-based strategies, so real estate equity being one. As rates come down, real estate is quite sensitive to lower rates, especially given the ramp up that we've seen over the past 2 years. And so that overhang in real estate is starting to ameliorate. So that should benefit real estate as the sort of bid-ask spread narrows and there's more conviction around what true valuations are. That's true for real estate equity. That's true for private equity, in my view. That's even, that would also support the elevated valuations in public equities. The other point we make here is finding opportunities to lock in fixed rates, given the fact that rates are coming down. Many people for the past year and a half have been sitting in cash, for example, or have focused purely on credit. We think that if you're in a floating rate credit vehicle, clearly there's a threat to that total return. So locking in more fixed rate vehicles at this point makes a ton of sense to us. And then the final point I'll make on this slide is the other thing we should brace ourselves for is not just inflation volatility, but market volatility writ large. That could be driven by geopolitics, by elections, you name it. And so having strategies in your portfolio that mitigate against some of that volatility is pretty important. So that's the quick answer. Now, down to some of the big ideas. Now, you heard me mention that we should expect more inflation volatility from here. And the reason is because of what we term tectonic shifts. So we did a ton of work post-COVID, post-Russia's invasion of Ukraine, to understand what had really shifted in the macroeconomy. And there are a number of things that have shifted, but we try to summarize them on this page. Fundamentally, these shifts are what are propelling us to expect more inflation volatility, which, again, as I described, has implications for your portfolio. And so they range from the accelerated energy transition, so that has been propelled both by Russia's invasion of Ukraine and the decline in supply of critical minerals, especially those related to clearly the energy transition. So think copper, think lithium, all of those are in very short supply as we march forward in making real this energy transition. The second is what General Petraeus calls the shift from benign globalization to great power competition. As students of history, I think we all can remember sitting in class and learning about Bretton Woods and times when the great Western powers sat around a table and said, you know, we have joint goals, joint values. Let's figure out how we can work together to achieve some of these goals and values of living. Today, while that's still the case, we still have, you know, warm relationships with many countries in Europe or the UK, for example. Today, there's actually much more of a focus on national and domestic manufacturing, domestic economy, and that has shifted a little bit of the focus from what we all may have experienced even 10 or 20 years ago. What does that mean? That means because the US, for example, in particular, is saying, we want to make sure we can manufacture critical goods here. Yes, we have partnerships around the world, but we want to make sure we have our you know, the right manufacturing facilities, et cetera, here. That means we are building new manufacturing facilities. We are doubling down on supply chain. So we're not just relying on a single cost-efficient partner in Asia, for example, to minimize costs in a supply chain. We're duplicating supply chains all around the world. So more domestic production, more duplication of supply chain, more nearshoring. On net, what does that mean? More cost, right? So as opposed to, and I'm sure you've heard this talked about, minimizing costs or just-in-time production, today we're much more focused on just in case. Just in case there's a war, just in case there's a shortage, let's make sure we're able to get those critical goods, and that adds a lot of cost and inflation in the entire supply chain. The third bucket here is the great labor rebalance, which is something I've been writing about for some time. I think we all have studied the aging population. We certainly experienced labor shortages because of the early retirements or excess retirement we saw during COVID. That is also putting pressure on costs and on inflation. So the labor shortages, demand supply imbalance drives up wage inflation, which was actually positive because wage inflation was so sluggish for so long in the US. But on net, that drives up costs, drives up inflation. So that's the third factor, structural factor, contributing to the big idea I'm talking about. The fourth one, when I describe it, most people scratch their heads because we're also students of the fact that what is the release valve you would pull if inflation or costs are rising too quickly? Well, technology, innovation, right? All of these productivity enhancements, that should work to reduce the costs that are building up in the system and that I've just described. But the reality is anyone who's in the AI space knows that the demand for labor, the demand for compute power, the demand for water, the demand for energy is in excess of what most people understand. And that in and of itself is driving up costs. And so even AI, which over the long term should help us address the inflation problem, in the short term is absolutely contributing to it. And so this paints the picture of why we expect higher inflation volatility or bias, and why, therefore, rates will be higher on the margin, given the fact that central banks are going to work to try to rein that in. The final circle in the middle here is, with all of these factors, governments are working to fund them, right? The deficit is something we have to solve for. That's also the lever that's keeping rates higher. So hopefully just walking through that at a very high level, you get a sense for why we feel we have very high conviction in this new regime, which is very different from the pre-COVID regime, where we should expect more inflation volatility. And that, again, has implications, like you can see on this page, for the types of portfolios that will work. You cannot use the same portfolio over the next 5 or 10 years that you had in place in the prior 5 or 10 years. And this slide summarizes it pretty quickly or simply. So new macro regime, I just described that, higher inflation bias. The implications for asset allocation is that across the board, especially in equity-oriented asset classes, and this is over the long term, those returns are going to be pressured. I'm going to show you an analysis of public equities in particular, where over the past 5 years, the bet really was to sit in public equities. If you had just stayed in the S&P 500, you would have earned a 15% return on an annual basis. That was the bet. The public equities this year put up 20%. Going forward, though, the picture is very different. Valuations are way too elevated in a higher rate, higher inflation environment, especially right now as growth slows. That's going to be a headwind to public equities. Going forward, we expect the S&P to deliver closer to 6 to 7%. That's very different, right? And so the questions that I get all the time are, how do I fill that gap, right? How do I achieve the same target returns that I used to have in this new environment going forward? And that's where I think real estate plays a role, which is what this final column describes. In this environment, even more important is to lean into all the ways that you can achieve higher returns, right? The illiquidity premium is a pretty, downside protected, risk-adjusted way to do so. And so we can talk about a number of asset classes, but real estate is one of the ways where you can get a premium over public equity counterparts. In private equity, for example, just for the median manager, not KKR data, which I can describe as well, but in private equity, you can earn 400 basis points on average for the median manager over what you get in public equities. That figure increases if there's any dislocation or any pressure in public equities, which is what I've just spent the past few minutes telling you about, is what we expect. So next year, we expect that illiquidity premium for the median manager to increase to 650 basis points, right? So you get the drift of what I'm saying. And to be clear, I'm not saying do not invest in public equities. That is a mainstay in the portfolio. But what I talk a lot to individuals about is diversifying your portfolio, because if you take away anything from what I've just described, what's going to be most important from here is actually having true diversification in your portfolio, because the 60-40 public equity, public bond portfolio is not going to deliver that going forward. So a couple of points on the macro, and I just wanted to make sure I wasn't too far on time. So I'll pick up the pace a little bit. So this page is just showing you we do expect inflation to come down. So we're in a disinflationary part of the cycle, though overall we expect higher inflation volatility. We're most constructive on growth in the US and maybe Japan. Europe, I think we've been experiencing disinflation. They're cutting rates right now. We're probably most concerned, not most concerned. China is where we probably have the highest level of concern. But if Europe doesn't, introduce more innovation, address some of the regulatory problems, I think they face a number of headwinds over the next 10 years. From a productivity perspective, they really haven't kept pace with the US. And then from just an energy cost perspective, if you're setting up a manufacturing facility, it costs 4 times as much today to do so in Europe versus the US. So there's just a number of challenges facing the region. I've already talked about this. There are a number of central banks who are cutting rates, but certainly Japan is raising them off of a pretty low base. In general, why this matters, that's a benign environment for risk assets, right? So if rates are coming down, the cost of borrowing is coming down, that's the time that you want to lean into your equity-oriented asset classes. Now, one of the questions that was posed to me is, how do you take advantage of some of the volatility in the system? And I wanted to make sure I had a couple of slides here on elections. The reality is, though the media portrays a President Harris versus a President Trump to be diametric opposites, there's actually a lot more that will remain the same than that will change. And some of the things that will remain the same are the structural forces that I mentioned. So we're still going to focus on sort of this more America's first approach to things. We're going to have to address, AI will continue to be a focus. I think there are a number of factors or positions that will remain the same. The areas that will remain different are obvious, right? So taxes, the tax policies of both are going to be very different. Regulation is going to be very different. Tariffs are going to be very different. And I think that is probably the most relevant for this audience, where under both administrations, we will have tariffs, right? But what President Trump has proposed will be much more severe in terms of tariffs he plans to implement. Personally, what I worry about is I think it makes sense to protect domestic manufacturing. I'm just not sure tariffs are the right way to do it. And what we've seen instead is that, in protection of U.S. manufacturing, we've implemented tariffs, but China then just trades or manufactures through Mexico. or through Vietnam. And so I'm not sure that it actually is effective to pursue that route. And on that, what I thought was interesting is you would think on the face of this that a Republican Trump presidency is going to be the best set of policies for the economy. But the other side of it is if the policies prove to be as inflationary as we think, that could actually end up harming the economy more. So that is the sort of toggle that I think about when I think about both election outcomes. Regardless, because you can never, they're in dead heat right now. What I talked about to individual investors, because it's literally 50-50 across the board, is remaining invested and leaning into long-term secular trends, because no one is able to predict election outcomes today. And if you are, scared and you liquidate all of your assets, you're actually locking in, lower marks and missing out on the great opportunity that we've seen over time often presents itself. And what this chart just shows in summary is that if you remain invested during these times of election uncertainty or policy uncertainty, a portfolio that does that versus one that liquidates or sells during these times earns an incremental 25%, has a net 25% improvement in assets versus one that, again, is more fear focused. So let me start to pull this together and make sure I have time to get to the specific real estate section. So here's, summary of what I talked about earlier: new regime, higher inflation, slower growth over the next few months. This right-hand chart is what you should pay attention to, which is this is the correlation between global stocks and global bonds, which are elevated in this type of environment. This is what is not going away. And this chart is one I'd want you to focus on, and that's why the yellow box is here. As we do our own proprietary modeling on asset class performance across the board, both public and private, you notice a number of things. And these are KKR models that we've used for the past 15 years. Look at the S&P 500 in the middle there. That's the point I was making about historical versus future returns. Historical returns for the S&P over the last 5 years, 15.8% annually. Going forward, that's the 6% I'm talking about. Different environment. Now look at real estate, and most people are shocked by this, given how much real estate has been beaten up over the past 5 years. But as a result of that, over the past 5 years, private real estate, and this median manager data, has delivered 6.6 returns on an annual basis. Going forward, across most of, excluding private equity, across most of the private asset classes and even some of the public, real estate is actually set to outperform. So perform better than it has done over the past 5 years, which is different from, certainly the S&P, different from private infrastructure. And that's one of the reasons why I think it is well positioned. Why is it the case that we're looking at, better performance over the next 5 years? Well, obviously it's because we've seen a lot of repricing in the asset class, right? And we're seeing a lot of repricing in the asset class that was not driven by fundamentals, right? When I was on the road and I used to work closely with the real estate investment team at our firm, the question or pushback I would always get is, you told us to invest in real estate, but it didn't work. It's not an inflation hedge. And I would always say to them, we have to use sort of a multi-factor regression. And there were more factors than one at play. Certainly, there was higher inflation, but there were also massively higher rates. And so the rate factor trumped everything else. So real estate couldn't survive the 525 basis point increase in rates over an 18-month period, right? So we saw the 30% decline in valuations. But I would argue because the fundamentals of real estate remain very solid, we still have an undersupply of housing. We still have all of the shifts around digitization and the support for data centers and the like. That's going to support real estate going forward. Near term, this is a summary chart that says near term this is the turning point for leaning into real estate. This chart just plots the sensitivity of the asset classes in terms of rates on the x-axis. So you're more sensitive to rates if you're farther out on the right. And then the sensitivity to GDP on the y-axis. And so real estate is positioned well here because this is just using 30 years of data. It has been demonstrated that when rates come down, valuations in real estate increase, which is intuitive, but we just wanted to show it on paper. The other thing is, in this environment where short rates are coming down in particular, cash yield is very important, right? So real estate being able to lock in that NOI growth and achieve that cash yield on a consistent basis that's inflation hedged going forward is also a part of the value proposition that is underappreciated. But there are going to be a lot of investors who are worried about reinvestment risk because they've been sitting in cash for so long. And real estate is a place where you'd want to reallocate at least some of those dollars. As an aside, I recently hosted 10 CIOs from around the world, Morgan Stanley, Bank of Singapore, UBS, et cetera. And what was surprising to me were the numbers they were all talking about in terms of how much money is sitting in cash today. The numbers that they said were 30%. 30% of individual wealth portfolios are sitting in cash. So, I saw a lot of people in that meeting start to salivate because everyone says, oh, well, that's the opportunity. They're all going to send that into my strategy. But seriously, maybe not 100% of that 30%, but that's a lot of cash to be redeployed over the next 12 months. And that is an opportunity for real estate. So how would I contextualize this? You're going to know some of this already, being practitioners in the industry, but clearly the significant rise in interest rates certainly put pressure on real estate valuations. You can see the widening of cap rates, not just in the US, but Europe. What we're, starting to get constructive about is the fact that even in the public REIT space, where clearly it's traded, so we're getting more timely data, you are starting to see a rebound there, but we're not yet at the sort of pre-crisis levels. Investment volumes are down in the industry, but I can say for KKR, this has been one of the most active years we've had in real estate in some time, right? So we're very excited about the change in the environment. This has been despite the fact that fundamentals are sound, this has been a pretty significant drawdown. So here on the left-hand side, you're just comparing drawdowns, peak to trough drawdowns in different cycles. And so we're the second largest on record. So that's what we've just experienced. And it's taken a little bit longer than it has. And so that's why it has felt so painful. But the far right chart is what we should start to get excited about. It is from these types of lows that you get significant excess return going forward. And that's not on a 6-month basis or a 12-month basis, but you see that the real bang here is on a 3-year basis. So from here, and consistent with the chart I had a few slides ago, expected returns over the next 3 years are quite positive. And to the point I've been saying this entire time, fundamentals are still strong. We were largely talking about maybe a technical issue or a leverage issue, which is largely abating. If you look at fundamentals by region, by subsector and strategy, they're quite strong. Residential, we're still undersupplied in most areas of the world. Student housing, we're certainly focused on that in the US and in Europe. Even office, which is further down on the page, where all the headlines in the US beat up on office all the time. It's hard to, a class B or C office is not, where you want to play today. But look at the fundamentals in office almost everywhere else, especially in Asia. We're doing a ton in office in Asia. And so all this to set up is that while the headlines have been focused on doom and gloom in real estate, there's actually a lot to be constructive about. And so picking your sectors, picking your markets is really the name of the game, because if you think about from an entry point perspective, this is a good basis to enter and acquire and do business. I think I have just a few more slides to go, and then I'll open it up for questions. Now, how do we play in real estate? We have the benefit of having both a real estate credit as well as a real estate equity business. For the past 2 years, it really has been a good time to be a lender in general, but certainly in real estate. And why is that? Well, because we've seen significant retrenchment from banks. At the end of last year, banks represented 50% of the market in terms of debt outstanding, but that was down 65% from the prior year, right? So banks really stepped away given regulation, given what was sitting on their balance sheets. And so, and lending standards continue to remain tight. So we don't think they're coming back in the same way that they, used to exist in terms of being a provider of capital. So that creates opportunity for real estate credit. And so that is a space we continue to be excited about. We have seen some tightening, which is what you would expect in a cyclical business and at this point in the cycle, but it still remains compelling in terms of the spreads that are on offer, and especially as activity picks up on the acquisition side. Last year, for example, you would have said it should have been a boon in real estate credit, and it was from a spread perspective. But if there wasn't enough sufficient transaction volume, you really couldn't, solidify those deals, right? So now hopefully we'll get into a better balance where yields are still compelling, but there's a lot more transaction activity so that you can actually lend to some of those deals. And so with that, what we're getting excited about is the real estate equity opportunity. And that's the benefit, I believe, of being able to dynamically move between both, is they're cyclical, right? So when real estate equity is not doing as well, there's typically a credit opportunity. So we're in the middle of that handoff where real estate equity is becoming more attractive. One, if you cut the data by subsector on a valuation perspective, there's lots of value on the table, especially in those in favor subsectors. We don't expect this to be a distress cycle. We think of this more as good businesses that are pressured from a balance sheet perspective, right? Like the cost of capital has become too high, and so they need to sell assets, but they're fundamentally good businesses. So we're not looking for distressed assets. We're just looking for some of those sort of pressured business models. And so I'll close right on time on this last slide, which is, as Chief Investment Strategist, I traffic in multiple asset classes, but I always like to put this one up because it gives you a sense of relative value across asset classes. And this is a slide that I used to say, look at the S&P 500. I will continue to say that the bet over the past 5 years that everyone should have made was to lean into US public equities, right? Like that's where you made a ton of money. But where valuations are right now, it's going to be very difficult to replicate that performance going forward. So adjusting that position and diversifying by asset class, by region is really critical for portfolios. And you should diversify into asset classes that have good expected returns on a go-forward basis and also where there's a good entry point. And so here I'm just putting in a box here that real estate equity shows up as quite promising, given what I said a few slides ago. Fundamentals are still there, and you can acquire those properties at an attractive basis. So with that, I will stop and happy to take any questions if there are any. Thank you.
So one question that has been on the minds of all of us who either are developers or represent developers is you spoke about availability of credit, and it's attractive. But one thing that seems to be missing at the moment is no one's replaced the construction lending that used to be supplied by balance sheet loans from the large and medium-sized banks. And so right now, even though you have a lot of construction deals in the pipeline, you don't see new construction loans being originated to continue it. So, for example, in apartments, you may have a short-term oversupply as those projects that are in the pipeline deliver. But what happens 2-3 years from now, especially since it does not seem that the banks are the regulators are in any rush to allow banks to land on construction? What do you see on that going forward?
Thank you for the question. I'd say it's interesting to receive the question. On the one hand, I think of that as an opportunity, certainly, because if supply is constrained, then that helps you in terms of the value of a property in any of those areas. The other point I think of is JLL seems to have, delivered quite a number of properties this year, which seems to, how are they getting funding is what it comes to mind. I'd say typically in what we've seen in markets is that someone moves in to fill that gap. So I don't have an answer for you of specifically who would do that. I have seen, some parties certainly get access to that type of financing, but the fact that it hasn't recovered is not a surprise to me. But I would expect that someone to fill that gap, and I wouldn't know specifically whom.
I saw on the screen that you had like a light purple color for life science as an asset class in the U.S. And it seems like since the banks that cater to that industry fell about 1.5 years ago, that's been a significant source of distress. Can you talk about the life science prospects, for the coming 5 years?
Sure. And again, I don't want to present myself as a real estate expert, so I'll share from a macro perspective how I think about life sciences. Some of the macro trends around healthcare and especially post-COVID, this focus on being our own innovators around healthcare, as well as, the aging demographic, et cetera, that's what propelled the fundamentals around life sciences. But as you saw, there was too much capital running into the space too soon, right? And so everyone was in Boston, was in San Francisco, developing all of these life science facilities. And so whenever that happens, it's no surprise that there's going to be distress in the market. So I think there needs to be some normalization there, right? So it's, the corollary I think of is AI, right? AI is certainly here to stay and is an investable concept, but is every company that has a .ai behind it, does that mean you should invest behind it? No. And so will we have distress in AI? Yes. Does that mean AI is not a real thing? No, right? So I would say the same thing for life sciences, which is I expect the players who aren't substantive, who don't have either a real business model or real sustainable business model behind them, to continue to experience distress. And the market will get better at sussing those out, which are the true investable concepts versus just, the tagline that everyone is getting excited about. So that's my view.
The idea that we are heading into an inflationary environment and the concept of real estate as an asset class seeing a recovery seems somewhat contradictory, and understand both in that the interest rate environment and the inflationary environment and the run-up in rates has created such a downward pressure on valuations. How do you think about that, or how should I think about that? Because I understand what you're saying, but it seems as though there will be outsized recovery and growth in valuation over the next 3-4 years, but then that upward pressure on rates in that inflationary environment, what does that outlook look like beyond 3 to 4 years?
It's a great question. And this is where it's really about levels. So when I say we are headed for a higher inflation volatility or bias in the system, in no way am I saying that we're headed back to 9% inflation, right? I'm just saying if you think about the pre-COVID era where the Fed was struggling to get to 2% inflation, that's not the environment we're in. Inflation is here, but it will be closer to 2.5% to 3%. And in the face of that type of inflation and threats for it to be even higher than that, and as well as the need to fund the deficit and therefore that putting higher levels on rates, we're shifting not into maybe the Goldilocks era of real estate where rates were low, inflation was moderate, and you could do well in most areas of real estate, into a new environment where inflation is higher than it was, which real estate does well in moderate levels of inflation, so that's good. Rates are going to be a little bit higher, but not so high that you cannot generate a return in real estate. So that's how I would square it. It's a relative game that we should expect from here on in inflation to settle around 2.5% to 3% with a lot of volatility around it. Rates will be slightly higher. We think that the neutral rate settles around 3%. The 10-year is around 4%. So I'm not talking about anything egregious. I'm just saying there are many people in the market who expect a return to normal or a return to pre-crisis averages, and that's not setting you up well from an investment perspective. In the back.
When you had the slide up about the fundamentals, it looked like real estate like retail was stronger than people would expect. I wonder if that's segmented into brick and mortar versus centers for all of the online sales.
Like distribution centers or something?
Yeah.
It actually is brick and mortar, but it's one of these stories. The industries are cyclical. Retail has gotten beaten down significantly. And we have long believed that it's not that retail is going away, right? It's that we were overbuilt from a retail perspective, right? I used to know this stat off the top of my head, but if you compared kind of the retail square foot per capita in the US versus Europe, it was on orders of magnitude higher, right? And so we needed to normalize retail concepts and also redevelop them to meet consumer needs. So we're, I'm sure everyone talks about this now, but the live, work, play concept is one we're huge fans of, right? What is it that people want when they go into a store? What types of products, what type of experience? That's what we're more focused on, but we certainly don't believe that there's nothing to do in retail. It's just what type of retail, where, how large, that's really the focus.
Well, thank you, Paula.
Thank you.
As a shopping center person, I was very pleased to see your positive result on retail. We're tired of getting beaten down at ICSC, but you've really set the stage for our conversation about the future, Paula, because our next speaker is really, what's fascinating